Hello, everyone, and welcome to this Nadex webinar. What is technical analysis? I will get going here in 1 second. I'm having a minor technical issue, and I will be certain to get us going here quickly. Okay. I think I've solved it. There's always a challenge. Welcome to, what is it, Thursday in October. See? There we have it. Give me 1 more second and I'll get going. I apologize. I'll be right back. I will be right back. All right. I apologize for that. A few second delay. All right. Welcome to this Nadex webinar, What is Technical Analysis? And we are going to do some basics of technical analysis. And then I'm going to end up doing a very practical demonstration on the Nadex platform. I think you will really like that because it will potentially help you in your trading journey. Before I go any further, I do need to share this disclaimer because this webinar is sponsored by our compliance department, and trading involves risk and may not be appropriate for everyone. Any trading decisions you make are solely your responsibility and at your own risk. And this is an educational session. Please do not construe anything I say as a buy or sell recommendation. I am doing this for your education purposes, and that will become abundantly more clear when we move over to the off-roading portion of the webinar, which is when I will bring up the platform and we will actually demonstrate some of the technical analysis tools that I've introduced you to. Just quickly, for those who have not joined before on one of my webinars, I am Todd Rich. I am the head of education here at Nadex. I joined Nadex a couple of years ago, and it was part of a continuation of my extensive trading experience in both the trading industry and the financial services industry. I moved to Chicago back in the 90s, and I spent 8 years on the floors of Chicago exchanges trading. And then I moved to the exchange space and the brokerage space, working for Eurex, which is a very large futures exchange out of Frankfurt, Germany. They're part of Deutsche Börse Group. I worked for Boston Options Exchange. We rebranded Box Options Exchange, the New York Stock Exchange, and then E-Trade before coming over here to IG Group and doing education for Nadex. I did go to UCLA for both my undergraduate and my graduate degree. So it just gives you a little bit of a history about me. Now let's talk about what we're going to discuss in what is technical analysis. I am going to spend about a hot minute on who is Nadex, but I think it's relevant to the discussion, and it does sort of connect the dots on why so many retail customers are coming to Nadex. And then we're going to get into technical analysis itself. A little bit of a history lesson, like where does it come from? Who originated it? What's the idea behind technical analysis? And then ultimately, why do you even care? And that's actually, the real payoff is, why do you care? And then we're going to talk about some basics about how to read a candlestick chart, looking for trends, looking at reversals, looking for support and resistance, all terms that if you're not familiar with now, you will be at the end of the session. I am going to talk about indicators and drawing tools, and those are available on the Nadex platform. And that's when I will actually get into the platform itself and do a very practical demonstration. Now, quickly, I said a hot minute. We are going to move quickly through this, but who is Nadex? It's simply an acronym for North American Derivatives Exchange. And what's really important is that we are a regulated exchange. And I emphasize that. We are regulated by the CFTC, another acronym, that is the Commodity Futures Trading Commission. And the reason I mention that is most people are coming to Nadex to trade binary options, and there are other binary option providers out in the world, but there are only a few here in the United States that are regulated. We are the premier certainly the largest binary option provider in the United States. And for all those ones that are offshore that might look really slick, I would say caveat emptor. If you were to have any challenges or need some type of recourse, good luck to you when they are an offshore exchange. And a lot of the nefarious behavior that you hear in the binary options industry, in fact, all of it is done by providers who simply are not regulated in the United States. We are regulated. We have to adhere to all the rules, laws of the United States, and we are audited and overseen by a regulator. Now, what did Nadex do? We built retail contracts for the individual retail trader, and that is becoming increasingly more popular now. But what does that really mean? We've got contracts that have a very low cost of entry. You do not need thousands of dollars. You could do so with hundreds of dollars or even less. You can get into Nadex markets and participate in short-term price action. And everything you do at Nadex has clearly defined risks, so there are no surprises. You're not going to come in one day and have lost everything that you have because of some surprise. You know what you're getting into a trade before you put it on at Nadex. All right. Oh, by the way, if you aren't aware, we do have a refer a friend program. So if you have a live Nadex account, you can invite your friends to participate with you. You will have your own link that you could share with your friends. That link is specific to you. And if you invite someone and they register using that link and they place 5 trades within 30 days of applying for their Nadex account, we'll give them $100 and we'll give you $100. You each get $100, and you can do that with up to 10 of your friends. And the thing is about Nadex and a lot of our markets, people like to trade together. And it is a little bit of a social activity sometimes. Traders do like that. And this is a way to incentivize you to work with your friends and discuss with your friends and try to find trade ideas with your friends. So we do have this refer a friend program. Now, the last thing I want to point out before I jump into all of this, as I start getting into the technical analysis part, on the right-hand side of your screen, you have a little question mark, and it probably has a 1 in it. And if you click on that, it will open up the questions panel. And if you have a question for me as we go, I will try to answer it. We can make this interactive while I'm here. This is live. You've got me right now. Now, if you ever have questions after this, you can certainly reach our customer service desk. I will give you that contact information later. But if there's something that you would like me to discuss, if I could fit it in, or if I didn't clarify something and you've got a question, please type it in. I will do my best to monitor those questions and answer them as we go. Now, a little history lesson. Where does technical analysis come from? And I am going to mention a name, Charles Dow. You may have heard his name before. You may not, but when you hear about all the things that he's done, you will certainly recognize him then. He did live in the late 1800s, and he founded a company, Dow Jones and Company. Now, he founded that with his partner, Edward Jones, a large name in the financial services space. But between Charles Dow and Edward Jones was a statistician, and Charles Dow had some ideas. Now, what they did with Dow Jones and Company is they started a little newsletter that eventually turned into the Wall Street Journal. You probably have all heard of the Wall Street Journal. And then the other big thing that Charles Dow left behind was the Dow Jones Industrial Average. And we all hear about that every day when we hear about what's going on in the markets. They'll mention the large equity indices, and the Dow has been a main staple of that. Since then, they've added other ones like the S&P 500, which people track, or the NASDAQ, which are the technology stocks, or even the Russell 2000, the small caps and mid caps. But Charles Dow had an idea, and he built a company back in the 1800s. It was an independent newsletter, because back then, a lot of people for news, it was yellow journalism, is you would pay somebody to write an article. He wanted a true independent source for the financial services industry on what was going on in order for people to invest and trade in stocks. Now, Dow had an idea, and turned into what is now called Dow theory. And what Charles Dow had was he built some principles, some ideas to understand and analyze market behavior. What is happening in the markets? And that concept of Dow theory is the foundation for what eventually became technical analysis. So that is actually what we're going to talk about now. But it was rather interesting that he did have some ideas on what you may or may not see in the markets and how you could potentially analyze what is going on in the markets. And in order to do that, he needed numbers. He needed numbers for his friend Edward Jones to do some statistical analysis on. And that is why they actually invented the Dow Jones Industrial Average, was to give them a number so they can build some mathematical models around that. Now, what are the concepts behind technical analysis? What were some of the ideas that Charles Dow put forth in his Dow theory? And the first concept behind it is that markets are efficient. Right? And the idea behind an efficient market, the efficient market hypothesis, if you want to get into the academics of it, is that all news is immediately discounted in the price of an asset. So if a company were to announce a change in their sales, or if there were some type of incident that were to occur, that everybody knew all of that information, and buyers and sellers would all come into the markets, and the price of the asset would immediately reflect what everyone knew to be true, and that the markets are truly efficient, that everyone has access to the information, and that all the news out there is already baked into the price of an asset. Well, if that's the case, you could then take the price of an asset and put a dot on a chart. And you could say at this time, this asset was trading at this price. And then you could watch that price move in charts, and that you would be able to see patterns, that there would be readily identifiable patterns on that chart that you would be able to see, and that the prices would move based upon supply and demand. So since all information is baked into the price of an asset and it's all discounted immediately into the price of an asset, what's really moving prices around is supply and demand. When there are more buyers, the price will go up until there becomes a point where sellers are attracted in, at which points sellers would step in and the price would go down, and that you would be able to see trends. And those trends would simply change based upon shifts in supply and demand. Now, if you could see these patterns, and the question is if you could see these patterns, you could identify them, that these patterns would then repeat. And you could actually learn to look for these patterns and try to identify when they were occurring. So that ultimately leads to why you would care about technical analysis. And why do you, or why does a trader care about technical analysis? Is traders are looking to take advantage of reading charts and identifying those price patterns. Because if you saw a pattern that you thought was something that you had seen before, you would be able to then see a trend, and you would be able to identify a trend, whether a trend is going up or a trend is going down, and it might lead you to buy or sell an asset. Also, if you were looking at these charts, that you might see points where you would say, oh, I know this is trending, but now I'm seeing the pattern shift a little bit. That shift, meaning it might go in the other direction, is called a reversal. All right, so we talk about trends where you see the price constantly going up, or you see the price steadily going down. At some point, that trend will stop and there will be a reversal. Sometimes those are called retracements, where it then goes back in the other direction. In the industry, we have a saying, the trend is your friend, or don't fight the trend. So ideally, you can look at these patterns, you can identify these trends, you could or potentially identify these trends. You could potentially identify these reversals, and that you would then be able to use that for trading decisions. And that is what Charles Dow was going after, that all the information is baked into the price of an asset. You would be able to price that asset and put it on a chart and plot it on a chart, and that you could look for different types of trends or repeating trends, and you could identify them on a chart, and you could use that as a way to identify when you would want to get into a trade. That looks like a level where I'd want to sell, or that looks like a place where I would want to buy. And that's how you would get into a trade. And then you would also help you with exit points. And those exit points would be, all right, I identified an entry point. I went ahead and I bought something, and at what point would I expect to see the trend reverse, and I would want to get out of the position or exit the position and take a profit. Or I bought something because I identified a trend, but I was wrong, and I'm seeing something else occur. Where do I want to stop my losses? Where would I want to cut bait, and I misread the chart, or it wasn't the pattern that I was looking for? So you would use the chart, and you would use the trend, and you would use your analysis of what's going on in the markets to identify entry points and exit points, whether they be profit taking or stop loss levels. That is why you care about technical analysis. So with that, let's start with the very basics of reading a candlestick. All right, a candlestick is the most common type of chart. There are other forms of charts. I will show them to you, but this is clearly the most popular one. And essentially a candlestick, there are two types of candlesticks. There are green candlesticks and there are red candlesticks. Now, I'm going to get a little bit more into the time frame of what this candle represents, but for example, let's assume each one of these candlesticks is a 15-minute candlestick. What that means is this little picture, this green picture right here, is one candlestick, and it represents 15 minutes of time. And the reason it's green is the candlestick has two components to it. It has a body, which is what's colored in green, and it has wicks. There could be a wick to the top, there could be a wick to the bottom, there could be both. In this case, we've got both. Now, when you're looking at a green candlestick, the bottom of the candlestick is where in that 15-minute period, the price of the asset was when it opened. It started this 15-minute period at that price. Now, the top of the body indicates where in that 15-minute period, at the end of 15 minutes, where the price of the asset closed. So clearly, it closed higher than where it opened. That is why it is a green candlestick, because it shows you that during this 15 minutes, the price actually went a little higher. Now, what the wicks show you are the extreme ranges. Now, if it had traded, it opened here, it traded all the way up to the high and then came back down and closed here. I know where it opened, I know where it closed, but the high during the 15 minutes is the top of the wick. And just the same, the low down below would be the low range during that 15-minute period. Now, the open and the low could be the exact same number, in which case there would be no wick on the bottom. And similarly, the close could be the high price during that 15-minute period, in which case there would be no wick above. The close and the high are the same number. So if you don't see a wick, it simply means the opening price or the closing price was also either the high or the low. All right, and are we clear there? Good. There was a question, and I think we're all good. And yes, that is exactly right. I'm answering a question right now. A red candle is the exact same thing, except it opened and it closed lower. So that is why you would have a red candlestick. The time that it opened and the time that it closed at a lower price, so it fills in the body as red, so that you can clearly tell that that was a red candle or a down tick, if you will. And there is a range. Again, there's a high range and a low range. You don't need to have a wick, but generally there might be one, but you don't have to have one. But these are what candlesticks are. That is how you read a candlestick. It gives you the open and the close during a specific period of time, whether it be 15 minutes, 5 minutes, 1 minute, hourly, weekly. You could have a weekly chart, and we'll get into that very next. And that one candle is an entire week. Where did it open the week? Where did it close the week? What was the high for that week? What was the low for that week? Now, what you end up having, and let's go back to the 15-minute example and assume these are 15 minutes. Every 15 minutes, you would get a new candle, and a new candle would print. And what'll end up happening is over the course of an hour, you'll have 4 candlesticks, each one representing 15 minutes. Over the course of 2 hours, you'll have 8 candlesticks. And what ends up happening there with your chart, as you plot time and you look at price movement, you'll actually have a full-blown chart of a bunch of candlesticks lined up next to each other, where you could try to look or identify different patterns to help you potentially identify entry and exit points. Now, I've been speaking a lot about time, and that's what we really need to talk about here for a minute, is when you're looking at trends or you're looking at candlesticks, time frame becomes very important. So what are we looking at? Are we talking about a short term, or are we talking about a longer term? And that references 2 different things. So let's just look at a chart, for example. I've got a candlestick chart up here, and with no other information, you could simply look at this candlestick picture and you could say, this looks like it's in a downtrend. And you can actually draw a trend line in there, and you'll see that it is sloping down to the right. And yes, it started this little picture, you could see the price was higher to the left, and to the right, the price was lower. We're in a little bit of a downtrend. Now, what happens if I back up a little bit, right, and I take a step back and I look at a slightly larger picture? Now, if you actually look, the picture on top is actually the same picture right below. It's the same. I just simply took a little snippet. Now I've given you more information. You back this up and you actually might say, well, wait a minute. We look like we're in a uptrend. Well, yes, we're in a longer term uptrend, right? The bigger chart, the longer term chart shows like it's slightly in an uptrend, whereas the shorter term chart just to the right, is actually a little bit of a downtrend. So time frame absolutely matters, and it matters for 2 things. It matters for the date range on your chart. How much am I looking at? The top chart might be 1 day, and the bottom chart might be 3 days or 4 days. So looking at the date range of your chart will impact what type of trend you are seeing. It is also very critical, the time interval for each candlestick. So when we're looking at these candlesticks, are these 1 minute candlesticks? So in that case, the bottom chart might be, and I'm just going to take a stab at it, 3 or 4 minutes of time. And the top candlestick, if those were 1 minute candles, might only be, how many candlesticks look like in there? 10, 20, might be 30 minutes of time. All right, so how those time intervals become very important. But when you're looking at trends, at the date range of your chart, how far back do you want to look? How up close do you want to look? And for your candlesticks, and you will use all of that. When you're doing your analysis, you might want to start with a little bit of a longer time frame. For instance, at Nadex, a lot of customers might start looking at 30-minute charts and then zoom in at 15-minute charts or even 5-minute charts, and then move down to 1-minute charts and try to look at different trends they're seeing, both at the 30-minute level and at the 1-minute level, particularly if they're trading short duration binary options that might only be 5 minutes long. Understanding the broader range helps, but knowing what's going on right now also helps. So when you're doing your technical analysis, it is important to be mindful of your time frames. Now let's talk about, we've talked about trends. I mean, you've actually learned a lot of terms here. We've talked about trends. We've talked about, now we're going to talk a little bit about reversals. And now I'm going to show you two types of candlestick formations, and there are a bunch of different candlestick formations. You can go look up technical analysis on the internet and you'll find I mean, there's so many different types of patterns that people see. I am going to give you a couple of the basic ones, and these ones, because it fits within the story that we're talking about. First, I spoke about trends, where you're just looking, is it in an uptrend or is it in a downtrend? Is that trend a longer term trend or a shorter term trend? Well, then how do you potentially identify reversals? And two of those are the hammer and the hanging man. So let's talk about the hammer first. Now, here's a picture of the hammer trend. And again, you can see on the right side, we've got some candlesticks, right? And the hammer itself is the picture on the left, okay? Now, each one of these in and of itself is a hammer candlestick. Now, but it has to fit within the context of the broader chart. Now, we do have two different types of hammers. We have green hammers and we have red hammers. And in fact, it's called a hammer because it actually looks like a hammer. Right? There's a handle and then there's a head. Now, with a green hammer, the open is it closed higher, so it clearly was moving higher in this candlestick range, and there was this long wick down below. And notice there is no wick above. There is no wick above, and that is a green hammer. Now a green hammer is a stronger indicator. It is certainly a stronger indicator because it closed higher than where it opened, but a red hammer can also exist. It simply is not as strong as an indicator. Now, what are we looking at? For a hammer, we're looking for a reversal. And you can see in the chart itself, we are in a downtrend. We are in a downtrend. You can see that we're moving lower, and all of a sudden, you've got a hammer that showed up. And what they're really saying is sellers were in control. We were talking about supply and demand. We're in a downtrend because sellers are in control and there's selling pressure. But then we got to this candlestick where the sellers tried to take it even lower. They simply were unable to push it any lower. That's why you got this long wick down below, and you actually formed a hammer where it opened, you got this long spike down, and then it closed a little higher. We're in a downtrend, and that's where you might expect to see a reversal in the downtrend, where buyers have now stepped in, sellers have become exhausted, and you see the trend turn. You see a reversal. You see a downtrend reverse into an uptrend. Now, the hanging man is the exact same concept. And now, although with a hanging man, a red candlestick is a stronger indicator than the green one. Now, if you notice, they actually look pretty much the same. A hammer and a hanging man, the candlestick looks different. The difference is that when you see a hammer at the bottom of a downtrend, that would be an indicator potentially to see a reversal to the upside, whereas a hanging man is something that you see in an uptrend. You've got you've got the asset moving higher, it's going higher, then you see this particular candle formation. Wait a minute, we might be seeing a reversal, and it becomes a sell signal. So a hammer is a buy signal in a downtrend, and a hanging man is a sell signal in an uptrend where you're looking for a reversal. Good. I think we're all clear on that. All right, so we've now spoken about trends. We've spoken about reversals. Oh, and I'm just highlighting it. A hammer is a buy signal, a hanging man is a sell signal. Let's talk about support and resistance. These are other terms that we said we would mention. And what does it mean? Support and resistance. And support, if you look at charts, or resistance, it's areas where you tend to see, now there's no specific candle formation, but points in a chart where buyers tend to step in or where sellers tend to step in. So on this particular chart, here's a chart of the S&P 500. And you can see when on this candlestick chart, when I drew this horizontal box across the bottom, whenever it seemed to have hit this price level, buyers have stepped in. Buyers supported it here at the beginning. When it came back down, buyers supported it again. When it went back up, buyers supported it again. This is clearly a support level, and people do look for support levels, and they look for support levels, and then they look for it to get tested. And eventually, and then it's up to you to make a determination based on patterns that you've seen. Is this support going to hold? And are we going to see a bounce off of it? Or is it finally going to break through that support and move through it? Now, on the upside, it would be resistance. So here here's a resistance level. Whenever it got to this price level, you can see we consolidated here at the beginning, and it sort of slowed down. And whenever it came back up to this level, it met resistance. This is what people mean by support and resistance. Where are levels where buyers tend to step in and give it support, and where are levels where sellers tend to step in and give it resistance? And then you're either looking to trade the support and resistance, or you're looking for a breakout. And there's different ideas around that. For instance, there are some people who do technical analysis, and they'll look for support and resistance levels, and they have this idea around threes, where a support level will work 3 times, and the 4th time it hits it, it's going to break out. And just vice versa, that they'll see resistance be a resistance level 3 times, 1, 2, 3, and the 4th time it comes up to that resistance level, it's actually now going to break out. Again, these are all things that you would have to make a determination on what works for you and what do you find successful when you're looking at charts. All right, so that's a bit about support and resistance. I'm going to go one step further because there are tools out there that help you with support and resistance, and I'm going to give you probably the most popular one, but there are other ones. I'm going to talk a little bit about Fibonacci retracement, okay? And then I'm going to show you Fibonacci retracement, and we'll talk a little bit about it now, but I think it really makes sense when I show it to you on the platform. But there are other ones with support and resistance, like Bollinger Bands. I mean, there are a variety, and you'll see how many we have, and there are a lot of different choices available to you on the Nadex platform to help you do some of your own technical analysis. But a Fibonacci, it's a mathematical relationship. Ultimately, when it comes down to it, it's a ratio. Interestingly enough, it is a ratio that we see in nature all the time. You see it in the ratio on the spiral of a snail shell. You see it in a flower, on how the ratio of different elements of a flower. You see it on the human body with the ratio from the head to the torso to the whole body. We have replicated it in architecture. It is a naturally occurring ratio, and it's something that humans have also then adapted to, and people have taken that ratio, and it's a mathematical model. I'm not going to get into what that mathematical model is. You can certainly go and look at it, and they apply those ratios. Now, again, we've got the tool. You don't have to be able to do the math. In fact, you can simply draw Fibonacci on your charts, and I will do that for you, and it gives you the different ratios on your chart where and this was, we were in a downtrend here, right? We could see that we were in a downtrend from here to here. And I'll show you, when I drew that on there, it actually gave us some interesting Fibonacci levels where there are different retracement levels. When it came all the way down, it started up here in the upper left, it came down to the bottom right, and these different levels, these different ratios in between ended up acting as support and resistance at different times. For instance, this 76.4 level, when we came back up to it, when we retraced, we started up here on the left, we went down to the right, we retraced all the way to that 76.4. When you've seen this pattern before, you would expect that to be resistance, and in fact, indeed, it rolled over. Right? And in fact, it came all the way back down to here where it acted as support again. So I'm going to do a little bit more of this when we get onto the platform, but it is rather interesting with a lot of people looking at it. You will see that there are places where resistance, there's the 50% line, and even support down here at the 23.6, the 24% level. Look how many times it kept on testing this level, and it acted as support for it. And clearly it broke through here, but when it broke through, it came right down to the very next level. So people do look for these ratios, this Fibonacci retracement levels, to give them ideas on where they might want to potentially get into or out of different trades. When I talk about indicators and drawing tools, when it comes to indicators, I mentioned Bollinger Bands. There are so many different indicators that are available. If you're not familiar with what these indicators are, people use relative strength, people use moving average convergence divergence, people use moving averages in general. There are so many different indicators that are available. If you don't know what they are, we do have in-platform education where you hover over the little eye and it will give you a little bit of education about what that particular indicator does, and you can learn to try to use some of these different indicators. There is a lot of information available for each one of these out in the world. I'm certain you'll be able to find it. There are also drawing tools available to you. And so you can draw patterns that you see, and we've got different ways for you to draw on your chart, whether you want to be drawing lines, trends, triangles, whatever it is that helps you in your journey. Fibonacci retracement and Fibonacci extensions, I mean, another one, but we'll just stick with the first one, which is a retracement. It does I'll show you how to use it. I mean, that's one that a lot of people like to use because it's pretty easy to use, at least to put it on a chart. And it does help a bit when looking as you learn. And a lot of this is just learning the language and looking at a chart and playing with the tools and becoming comfortable and familiar with the tools that work for you. And then once you're comfortable with that, and you can practice in a demo environment as much as you want, and then when you feel you might have a hang of it, might be when you want to start testing it out in the real markets. Realizing that a demo environment and a real environment will be different when you actually trade, but the charts will be the same. The charts will be exactly the same. Now, this is an important rule when using technical analysis, and I cannot emphasize this enough. So if you dozed off a little bit while we were going here, I hope I got your attention back, because this is absolutely critical when you're using technical analysis. And this is the second time I'm using this phrase, caveat emptor, buyer beware. Just like I mentioned, if you're going with an offshore binary option provider that is not regulated and has a history of nefarious behavior, well, that's your risk. Well, when you're using technical analysis, it is also caveat emptor. As the saying goes in the industry, every ship on the bottom of the ocean had a chart room. Right? And how good was that chart room? They had a chart room, they were looking at charts, and they still hit something and sank. So same goes for when you're using charting and technical analysis in the markets. These reading of charts is not 100% accurate, all right? So it's a tool. It's a tool to help you on your journey. And there are certainly some things when there's enough people looking at these tools, you actually have a lot of people who it almost becomes a situation where you make some of these things happen because there's so many people buying into it. But it is very important. Manage your risk. Just because you see something on a chart doesn't mean that's what's going to happen, which is why you want to manage your risk, which is also why you can use your technical analysis, not just on when you would want to get into a trade, whether you're buying or whether you're selling, but also when you want to get out of your trade. And remember, that means, yes, that potentially mean profit taking, but also stopping your losses when you're wrong. You don't want to sink to the bottom of the ocean. And that is very important when using technical analysis. Great tool, very helpful to help you see what's going on in the markets, trying to identify trends, trying to look for reversals, looking for support and resistance. And there are a variety of tools out there that you'll have to become familiar with, but please be careful. Manage your risk, which is why a lot of people, again, come to Nadex products, because your risk is inherently managed because everything has defined risk in it. All Nadex products have defined risk in it. All right, with that, if you've got any questions about any more of this, I think I've answered all of them. Before I jump over to the platform and spend a little time playing around with some of the tools that are available to you, if you've got any questions, you can absolutely email customer service at Nadex. I would also recommend that you follow us on our social media, particularly YouTube. In fact, I'm going to show you why right now. Let's move over and start doing the off-roading. And if anyone's got any other questions, please, I've answered all of them so far, but if you've got any more, please fire them in, or if you'd like to see something. I am now going to switch over. And I mentioned YouTube. I'm actually going to bring this up first. If you're not following Nadex on YouTube, I would recommend that you do that. This is the Nadex YouTube channel. You just simply go to YouTube, look for Nadex, and subscribe to our channel. You'll then get notices when we post additional comments or content. So for instance, this session is being recorded. If you'd like to review it at your leisure, you'll find it on our YouTube channel. In fact, there's a lot of content up on our YouTube channel. And if you go to the videos section, and this is what I really like to point out, I mean, you can see how much content we are constantly publishing, new content. You'll find this recording right here. And also, every morning at 7:45 a.m. Central, 8:45 a.m. Eastern, we do a live stream and we do analysis on what's going on in the markets. We take a look at headline risk for the day, and we spend 15 minutes going over what's going on in the world, what happened overnight, where are the hot spots, what news events might you want to be looking at today, and we actually look at charts. We actually look at charts and we play around with them a little bit to help you try to identify where you might want to focus trading for that day. If you go, when you're in the video section, instead of seeing all videos or uploads, you can see our past live streams, so that you can see every day we go on for, and it varies, 13 minutes here, 17 minutes here. We went 20 minutes back on September 23rd. You can go back and listen to these. They're dated, but you can also, if you're subscribed to the channel, you'll know you can see upcoming live streams and you can see what we've got. And I usually schedule these out 1 or 2 weeks ahead of time. In fact, you can see next week, we are no longer going to be calling it Nadex Morning Analysis. We're going to be calling it Morning Market Movers. What's happening in the markets? And we do live analysis for day trading. I do this with a partner of mine, Brian Caprice from Keep Trading Simple. If you don't know Brian, he's a great educator. Brian and I jump on every morning and we just talk about what happened yesterday, what happened last night, what news is moving the markets. Let's look at those charts and let's talk about what could be potentially impacting them and where are we seeing support and resistance, and we might use some other technical indicators. Again, we're not making trading recommendation. We're simply trying to help you on your journey. So if you're learning technical analysis, it's one way for you to get in and start understanding how we look at charts and how you could potentially learn to do it yourself. Because in the end, that's the ultimate goal, is for you to figure out how to do it yourself. Now I am going to go ahead and jump over. Oh, by the way, if you go to Nadex, when you come to the Nadex website, you will actually see, if you wanted to watch it from this morning, or in the mornings, it'll say get ready to watch the one that's about to go live, and a little window will pop up and you can actually subscribe right from here, right from the Nadex website. We make it easy for you, and you can listen to what we did this morning. And in the morning, this actually changes to, hey, get ready, it's about to go live, and it would take you out to YouTube so you could join the live stream. All right, I am now going to go ahead and log in, and I'm going to log into demo. Now, if you don't have a demo account, I would highly recommend that you get one. A live account, obviously, but playing around in demo and practicing some of your skills in demo is a good idea. And in fact, if you're testing out new technical analysis tools or skills, by all means, try them out in demo first and get comfortable with them. Now, do realize, though, that while what I'm seeing, the markets, the prices are going to replicate what's going on or closely replicate what's going on in a live market, your experience in a demo environment will just be distinctly different. People in a live environment, it's real money, right? And in a demo environment, people could do all sorts of crazy things. They might buy 500 of something, or do something they would never do in a real environment. And so that is why your experience in a demo environment will always be different than what it would be in a live environment. So to get to technical analysis, I am going to go ahead and I'm just going to bring up a chart. And let's just I'm going to bring up an indice. And since no one typed in one that they would love to see, I'm just going to pick one. So let's go with the NASDAQ. All right, I'm going to bring up a chart of the NASDAQ. And let's hide this. And as you can see, I can adjust my time intervals. Do I want to be looking at a 5-minute chart? All right, and I've now look at this 5-minute, or do I want to be looking at an hourly chart? It's going to look at a little bit different because look how much more time I've got covered in here. This takes me back to September, back into September, whereas my 5-minute chart takes me back as it redraws. Well, that's interesting. There's a 5-minute chart takes me back to Tuesday. So time frames do matter. It's what what time frame are you looking at on your entire chart, and what's the time interval of your candlesticks? So I'm going to go back to a 30-minute chart on the NASDAQ. And let's just kind of play around here a little bit. And by the way, if you're looking for where you would, you can customize your date range. You can choose from any of these indicators that are out here. And again, if you're looking to learn what they are, you can hover over the little eye and learn some things about that indicator. The drawing tools, there's a variety of drawing tools that are available. If you're, if people are looking for channels, hey, I'm seeing something trade in a channel. Here's a quick little channel. I'll just do an idea of a channel. We're in an upward channel right here. You try to, and my drawing skills aren't the greatest, but let's just kind of fiddle around with it a little bit. If I zoom in, not quite there. There we go. A little bit better. But people put in a channel, and they'll look whenever it hits the top of the channel, it might plateau or sell off, but it does. And when it hits the bottom of the channel, it might be a buying opportunity. So just a drawing tool. Again, not giving you any trading advice, but just showing you what a channel does. And that channel doesn't have to be up. It could be a flat channel. Sometimes things are going sideways, and you could look for a channel that's, let's delete this one. Let's click on that and go delete. You might have a channel, and I'm just going to do this down here just for fun, just so I can demonstrate it. But your channel could be this, right? However you want to draw your channels, you would have to draw your channels. That last one wasn't a very good one, but I just want to show you can angle however you want. I mentioned Fibonacci. All right, I'm going to do a Fibonacci retracement, and it's rather interesting. Let's escape. I want to move this. So we're on a 30-minute chart. Okay, yeah, let's do this. Here's a 30-minute chart. Okay, and I'm going to go from this move here. Let's just go 30 minutes. Let's go over to Fibonacci retracement. And the way it works is it's 1, 2, 3. I'm going to start here on this chart. And it's all, you got to make your own determination. This is where it was in the top of an area. and it did trade all the way down to here. So here's going to be my retracement levels. And then I'm going to drag this over to the right. So 1, 2, 3. And we can see that there were places where Fibonacci, the 38, it did act as support, support, support. It kept on acting as support and it bounced off it until it went straight through it and gave us this bottom. Now, as it retraced all the way back up, what's interesting is I'm going to move this over a little bit. You know, there was resistance when it was meeting it here, but then today's been a good day. It broke through. Now, if I want to take a look, I've drawn this on a 30-minute chart. If I wanted to change my interval, I could move down to a 5-minute candlestick. Notice that my 30-minute Fibonacci's are still on the chart, and it might help me, even though I'm using 30-minute Fibonacci levels, and these retracement levels are on here, I'm actually looking at 5-minute candles, and it might give me a different perspective on where I might see support and where I might see resistance. I mean, right now we're between two levels, we're in no man's land, and what you would expect to see potentially, if it were to go higher, you might see some resistance up here. And if it were to go lower, you might see some support down here. And if it broke through the support, where would the next level of support be? It would be right here. And we actually see that on the chart over here where it has been past support. So that was me playing around, no trading recommendations, and just goofing around with Fibonacci. And again, how you draw that in time frames, it's all going to depend on how you want to look at it. And if I wanted to, I could have actually gone all the way back here and started my Fibonacci retracement level from this high, which was back on September 26th, down to this low and drag it over. And what's rather interesting when I do that, all right, now I've gone all the way back to here. What's interesting now is that 61.8 Fibonacci level is a resistance level that has been holding. All right, look at, I mean, it's come right back to this level. It also happens to be 15,000. So that would, I mean, this is almost an indicator that you would see resistance here. That yes, it's a Fibonacci level and it's 15,000, where you might expect to see resistance just because it's that the 000. And the question now is can it punch through that? And so I've just given you some ideas. Again, no trading recommendations, but how you could use Fibonacci. And if I wanted to drop this back down to a 5-minute, I could see the same chart, 5-minute candles with those 30-minute retracement levels. You've got to make a determination how you would want to use it yourself. All right, and with that, I want to thank everyone for joining today. We did go through quite a bit. I want to bring back just real quickly. I want to show you what we covered, and I am going to do this very quick. Let's go all the way back because we covered a lot. We covered a whole lot. There we go. And I just want to remind you what we covered today. Again, this was recorded. You can go back and review it. But we talked about the history of technical analysis. Thank you, Charles Dow and Edward Jones, for and a lot of the work of Charles Dow and Dow theory. But then we talked about how you can actually look at an individual candlestick, how to read that. We talked about time frames on whether you're looking for your candlestick, 1-minute candles, 5-minute candles, 30-minute candles, the time frame for your entire chart, and then how you're looking at to see trends. Are we in an uptrend? Are we in a downtrend? When might we see reversals or retracements? They're the same thing, reversals and retracements. Where might I see support and resistance? Where are buyers going to step in and give me some support? Where would potentially sellers step in and give me resistance? And there are a variety of indicators and drawing tools for you to put on your charts and for you to practice your own analysis and for you to start trying to read charts yourself. And again, I would encourage you, join us every morning. We live stream on YouTube. Follow us on YouTube, subscribe to our YouTube channel, and join us, and you can learn and watch as we do it every morning for about 15 minutes. Again, that's at 8:45 a.m. Eastern. And if you miss it, those recordings are immediately available. So again, if you wanted to go back, for instance, to today and go back for 15 minutes and just hear what we spoke about today, go back and listen to what we spoke about and see if it's something you'd want to join us with. And by all means, please share that with your friends. Would love to have more people joining us. And remember, we do have that Refer a Friend program. With that, thank you everyone for joining. Hopefully we'll catch you in the morning, and good luck in the markets.